Have you ever wondered what the heads of a huge firm like Goldman Sachs actually tell their shareholders? What they see as the big wins, the challenges. It's a fascinating window.
Yeah.
Today, we're doing a deep dive into exactly that. The Goldman Sachs shareholder letter from 2014. Our source is that letter itself, written by Lloyd Blankfein and Gary Cohn, who were leading the firm then. And our mission here is simple: unpack it. Figure out what was really important to them back in 2014 and, well, what it tells us.
And 2014, you have to remember the context. It was a pretty complex time globally. The letter itself calls the economy uneven. You had the U.S. starting to recover, the labor market getting better.
Right.
But Europe was still facing challenges. Growth was pretty constrained. And then in Asia, especially China and Japan, things were slowing down. It made everything feel, as they put it, extended, choppy, and oftentimes unpredictable because it's all connected, right?
Choppy definitely feels like the right word. But despite all that, the letter kicks off saying Goldman Sachs performed well, generating solid results. So, okay, let's get into that. How did they define solid results back then? What were the key numbers?
Well, they laid out the headline figures. For 2014, net revenues were $34.53 billion. Net earnings came in at $8.48 billion, and they made sure to note that was actually a 5% bump from 2013's $8.04 billion.
Okay, earnings up.
Yeah, and earnings per share diluted, that was up to $17.07 compared to $15.46 the year before. They also flagged the return on average common shareholders' equity, ROE, at 11.2%. And book value per share grew 7% in the year. So yeah, profitable, definitely.
Profitable, growing, got it. But reading the letter, what really jumps out isn't just those annual numbers. It's this massive emphasis they put on the firm's transformation since the financial crisis. It feels like they were saying, look, this isn't just about 2014. We've fundamentally rebuilt things.
Exactly right. They spent a lot of ink comparing where the firm stood financially at the end of 2014 versus the end of 2007, just before the crisis really hit. And the changes were, well, pretty dramatic. The balance sheet itself, down nearly a quarter, 24% smaller.
Wow.
But common equity, the core capital cushion, that was up 85%.
A huge increase.
And leverage, that's a key one. Gross leverage was cut by more than half, a 61% reduction. It went from 26.2 times down to 10.3 times.
61%.
Yeah.
That's a massive deleveraging in, what, 7 years?
It really is. And they didn't stop there. They highlighted liquidity cash. Easily sellable stuff was about 3 times higher than in '07. It made up over 20% of their entire balance sheet.
Much safer footing.
And those harder to value, less liquid things, the level 3 assets, down nearly 40%. They framed all of this as building a, quote, strong financial foundation.
Okay, and why was hammering that point home so important in the 2014 letter? What was the message behind highlighting that foundation?
Well, partly it was about showing stability, right? Proving they could handle market stress, those choppy conditions we mentioned. But they also linked it directly to being able to support clients, to be there with capital or market access when a client's needed it most.
Okay. So strength equals client service.
Exactly. And of course, it was also about demonstrating they were meeting all the new, much tougher regulatory rules, Basel III capital, liquidity ratios, all that. They even used it to argue the firm was now simpler, pointing out their balance sheet was like less than half the size of their average peer and staff levels less than 20% of peers.
Simpler for Goldman Sachs is still relative, I imagine. But okay, so a much stronger, less risky financial base. That's the context. How did they talk about their actual businesses? How are they performing, and what was the strategy?
Yeah, they really lean on the idea of their global client franchise. That was the core. They describe their businesses as mostly institutional, serving big players, governments, investors, and diverse and adaptable. The argument was this mix gave them, a balanced revenue stream, and it helped they had a variable cost structure.
Meaning pay, mostly.
Right, tying compensation closely to performance. They actually noted the correlation in the letter, pay for performance.
Okay. Did they break it down by the main business areas? How are those doing?
Yes, they went through the core segments, highlighting performance, but also where they saw opportunities. First, investment banking. They called it their preeminent client franchise. Big number here. Advised on over $1 trillion in M&A in 2014.
And $1 trillion. Wow. Okay.
Yeah, highest since 2007. They saw that as a sign M&A was coming back globally, and they stressed their long-term market share leadership, like over 25 years, across different sectors and market ups and downs. So the message was, we're positioned to win as activity recovers.
Got it. What about trading, their client services?
Institutional Client Services, or ICS. They called it one of their most dynamic areas, always changing. especially, they noted, because of new regulations. Interestingly, they saw those regulations as actually raising barriers to entry, making it tougher for smaller players.
Ah, so regulation favors the big guys with scale.
That was their read. They highlighted having top franchises in both fixed income and equities globally, and they believed the value clients place on liquidity being able to trade would likely grow. So, opportunity to expand market share there.
Makes sense. Then there's investing and lending.
Right, investing and lending. They framed this as core to their mission, providing capital. They talked about using their network, investing alongside clients. But the key strategic point here was the growth in lending. Corporate lending, real estate, private wealth clients. They said lending had basically doubled since 2012.
Doubled. That's fast growth.
It is. And they were quick to add that it came with, rigorous risk management, but clearly a strategic push.
And finally, investment management, asset management.
Investment management, yes. Assets under supervision had grown quite a bit, up 32% since 2011, reaching almost $1.2 trillion. They acknowledged they were maybe 10th largest globally, but saw lots of room to grow compared to the biggest players. What drove the growth? They emphasized client performance. Mentioned a high percentage of their mutual funds were top performers over 3 and 5 years.
Performance matters, okay.
And they specifically mentioned expanding their private wealth platform, connecting it back to investment banking, giving wealthy clients access to private deals like Facebook and Uber before they went public. They also mentioned making some acquisitions in this space, too.
So across the board, it sounds like the strategy was double down on core strengths like banking, leverage scale where regulation helped, like in trading, and then really push for growth in lending and asset management.
That sums it up pretty well. And they also pointed out they weren't just growing, they were also strategically shrinking in some areas. They listed things they'd sold since 2012, often driven by those new regulations like stakes in reinsurance, European insurance, their big ICBC investment in China, plus selling off businesses like hedge fund administration and the REDI trading platform.
Right. Streamlining.
Exactly. And the punchline was that even after selling those things, on a like-for-like basis, net revenues in 2014 were actually higher than in 2012. Driven, they said, by that growth in investment management and investment banking.
Interesting. Okay, shifting gears slightly. The letter spends a surprising amount of time on something less concrete, culture and people. Why was that so prominent?
Yeah, they really emphasized it. They talked about putting a huge priority on preserving and enhancing their culture, teamwork, client focus, long-term thinking. They connected their pay-for-performance approach and how they pick partners, a very rigorous process, to creating a true partnership culture and an ethos of long-term ownership.
Trying to show it's not just about the money.
I think that's part of it. And they backed it up with some numbers, too, like getting nearly 270,000 applications for about 8,300 jobs in 2014, and a very high acceptance rate for their offers. Plus, mentions of being ranked as a top workplace by Fortune, Working Mother, etc. It's about showing they're still a magnet for top talent.
They also took time to acknowledge leadership changes, particularly mentioning people who had passed away.
They did. They paid tribute to John Whitehead, a legendary figure there, really crediting him with shaping the firm's culture and developing leaders for generations. And also Jim Shiro, their former lead director. They highlighted his contribution during that really difficult period after the crisis, the tough scrutiny time, praising his judgment.
Acknowledging the past leadership.
And they also announced new board members, Mark Flaherty and Mark Winkelmann, making sure to point out their relevant experience in asset management, markets, risks, showing they were strengthening governance too.
Okay, so strong finances, clear business strategy, focus on culture and people. What about outside the firm? The letter detailed quite a bit on corporate engagement.
Yes, this section covered both engaging on policy issues and their community investment programs. They mentioned hosting summits on things like energy and U.S.-China investment, but they really drilled down on 3 specific initiatives. First, 10,000 small businesses. The idea was helping small business owners grow, create jobs, education, support services, access to capital.
How was that going in 2014?
By the end of the year, it was running in 23 locations in the US and UK, served over 4,000 entrepreneurs. And they cited a report showing real impact. 64% of U.S. grads boosted revenues within 6 months. 45% created new jobs. Pretty concrete result.
Okay, what else?
Second, 10,000 women. Similar idea, but focused globally on women entrepreneurs. Business education, mentoring, networking. The big news in 2014 was launching a partnership with the IFC, the World Bank's private sector arm, to create a $600 million financing facility specifically for women-owned small and medium businesses.
$600 million, that's significant.
It is. By end of 2014, they said the program had reached over 10,000 women in more than 40 countries. And again, they reported results. Nearly 70% of surveyed grads increased revenues, 60% added jobs.
Wow. And the third one?
The third was Goldman Sachs Gives. This is basically their charitable fund, a donor-advised fund. Senior people, managing directors recommend grants to nonprofits they care about. In 2014 alone, grants total over $146 million going to organizations in 29 countries. Since it started in 2010, they'd given out over $860 million globally.
Any particular focus areas for the giving?
They highlighted support for need-based financial aid at colleges and also support for military veterans.
So a clear message there.
Yeah.
We're involved, we're investing in communities, we're tracking the impact. It wasn't just an afterthought.
Definitely not. It felt like a core part of the story they wanted to tell shareholders. And then the letter kind of wrapped up by looking ahead from that 2014 perspective. They repeated the cautious view on the global economy recovery, still fragile, geopolitical risks were out there.
But despite that overall caution, they sounded pretty positive about Goldman's own prospects, right?
They did, yes. They actually said conditions were becoming more conducive for our set of businesses than in recent years. They pointed to good signs, strong U.S. job growth, better GDP forecasts, rising confidence among CEOs and consumers. And interestingly, they thought that differences in central bank policies around the world might actually lead to more sort of normal market conditions, maybe more volatility, which could be good for their trading businesses.
And they summed up how they felt they were positioned for that.
Yeah, it was a recap of the themes. Protect and grow the client franchise, the transformed financial profile, managing costs tightly, being smart with capital, maintaining the culture, attracting talent. They felt all this put the firm in a position to deliver operating leverage for shareholders, meaning, as revenues hopefully picked up with the economy, profits should grow even faster because they'd managed their costs.
Right, the payoff for all that restructuring and cost control.
Yeah.
So if we step back and look at this whole 2014 letter, it really paints a picture of a firm navigating that post-crisis uneven recovery. Huge focus internally on fixing the balance sheet, managing costs, becoming simpler and safer, but also externally focused on clients, on strategic growth in certain areas like lending and asset management, and very deliberately highlighting these big social impact programs.
Absolutely. It's a narrative of adaptation, resilience, and strategic positioning, trying to show they'd learned lessons, met regulatory demands, and were ready to capitalize on improvements, while also underlining the importance of culture and contributing through those specific initiatives like 10,000 women and 10,000 small businesses.
So thinking about all that, the deep financial changes, the business strategy shifts, the emphasis on culture, the corporate citizenship piece, what does digging into a document like this from a decade ago leave you, listening right now, considering about the role and responsibilities of these major global financial players? How does that 2014 snapshot shape how you view the industry today?
It really makes you think, doesn't it? In such a complex, interconnected world, how do these giant institutions balance their financial imperatives with broader societal expectations? And how well can one official document, like this letter, truly capture the full picture of their impact, both positive and negative?
Definitely a lot to chew on there. This deep dive has given us a really clear view, I think, into the mindset of Goldman Sachs leadership back in 2014. Fascinating stuff.